Forex trading explained for absolute beginners.
If you are watching this video today, it means one thing. You are curious about Forex, but also confused. Maybe you've heard people say, Forex is easy money. Maybe you've seen screenshots of profits online. Maybe someone promised you that you only need signals or a robot. And now you want to understand what Forex actually is, how it really works, and what beginners must know before placing a single trade. Today's video is for absolute beginners, not intermediate traders, not gamblers looking for fast money, not people searching for shortcuts. This video is for someone who is serious but overwhelmed, someone who wants the truth, someone who wants to understand Forex from the ground up. If that sounds like you, breathe in, relax, and let's take this step by step. Today I will explain what Forex really is, why prices move, what lot size truly means, why spreads matter, what stop loss really protects you from, how market structure reveals what the market is doing, the most dangerous beginner mistakes, and at the end, one practical takeaway you can start using today. No hype, no fantasies, just clarity. Section 1. What Forex really is, not what you've been told. Forex is not a get-rich-quick system. It is not a magic app. It is not a place where you turn $20 into $20,000 overnight. Forex is simply a global marketplace where one currency is exchanged for another. People trade currencies every day for normal reasons. Businesses importing goods, tourists traveling, governments adjusting reserves, institutions hedging risks, investors seeking better interest rates. You are not trading against brokers. You are not fighting banks. You are trading inside a gigantic market that existed long before retail traders like us entered the scene. But here's what most beginners misunderstand. You are not trading currencies. You are trading your ability to predict the direction of value between two currencies. For example, if you believe USD will be stronger than JPY, you buy USD/JPY. If you believe USD will be weaker than JPY, you sell USD/JPY. That's all. Forex is a market of opinions, beliefs, and probabilities, not guarantees. The earlier you accept this truth, the easier your journey becomes. Section 2. Why? Forex matters before how it works. If you don't understand why Forex matters, everything else will confuse you. Forex matters because 1. Currencies affect every economy. A weak currency means higher import prices. Inflation reduced purchasing power. A strong currency means cheaper imports. Stronger consumer value. Economic confidence 2. Forex influences businesses. Every major company that deals internationally uses Forex to hedge, protect, or convert money. 3. Forex affects your daily life. If your currency loses strength, your cost of living rises. 4. Forex trading teaches discipline. This market punishes impatience. It rewards consistency. It builds mental strength. Before you learn how to trade, you must understand why this market exists and why it moves, which leads us to the next topic. Section 3. Why does price move? The most important beginner lesson. Most beginners think price moves randomly. Some think smart money is manipulating me. Some think brokers stop hunt them. The truth is simpler and calmer. Price moves because the balance between buyers and sellers changes. That's it. But the reasons that balance changes include 1. Economic strength. If the U.S. economy shows strong employment and growth, U.S. dollars becomes more attractive. 2. Interest rates. Higher interest rate equals currency becomes more valuable. 3. Political stability. Stable governments attract investors. 4. Market sentiment. Sometimes large investors simply shift their focus due to risk appetite. 5. Liquidity. When large players enter the market, price moves to fill their orders. Price doesn't move because of you. It moves because of big institutional flows. And to understand price, you must understand market structure. Section 4. Market structure. Explained like you're 5 years old. Market structure answers a simple question. Is price going up, going down, or going nowhere? That's literally it. You don't need complicated names or fancy theories. 1. Uptrend. Higher highs plus higher lows means buyers are in control. 2. Downtrend, lower highs plus lower lows means sellers are in control. 3. Range price moves sideways. Means neither side is strong. Market structure matters because it keeps you from trading against momentum. It shows the path of least resistance. It prevents emotional entries. It helps you understand where price is likely headed. Most beginners trade inside confusion. Pros trade inside structure. Section 5, Lot Size. Beginner Trap explained. Lot size is simply how big your trade is. A bigger trade means bigger profits, bigger losses, bigger emotional pressure. Lot size is not about how much you want to make. It is about how much you are willing to risk. Most beginners choose 0.5, lot 1.0, lot 2.0 lot, with no calculation, no discipline, and no understanding. This leads to 2 disasters. 1. Account blowouts. Because one small movement becomes a huge loss. 2. Emotional damage because oversized trades affect your psychology, not your strategy. You must learn to treat lot size as a risk tool, not a profit tool. Section 6. Spreads. The silent cost beginners ignore. The spread is the small difference between the buy price and sell price. It is how brokers make money. Spreads matter because they widen during news. They widen during low liquidity. They affect your stop loss. They affect your entry accuracy. Beginners ignore spreads. Then they wonder why their trade starts in negative. You must respect spreads like you respect fees in real business. Section 7. Stop loss. The emotional seatbelt of trading. A stop loss is a predefined point where your trade automatically closes to protect your account. Stop loss does not guarantee profit, but it guarantees survival. Most beginners treat stop loss like a suggestion. They remove it, move it, widen it. This is emotional suicide. A stop loss is your seatbelt. You don't wear a seatbelt because you expect to crash. You wear it because accidents happen. Same with Forex. Stop loss protects you from sudden volatility, news events, wrong predictions, emotional decisions. A trader without stop loss isn't a trader. They are a gambler. Section 8. Common beginner mistakes. Honest truth. Here are the biggest beginner mistakes. 1. Trading without understanding market structure. Beginners chase candles. Pros follow structure. 2. Using lot size to get rich faster. This is the #1 reason beginners blow accounts. 3. No stop loss. The market doesn't care about your feelings. It will punish you. 4. Overtrading. The market will always be there. Your account won't. 5. Trading. Every day, there is no rule that says you must trade daily. Opportunities come when the market decides, oh, not when you want. 6. Trading news without experience. News volatility destroys beginners. 7. Wanting signals instead of skills. You cannot borrow someone else's discipline. You must build your own. 8. Impatient expectations. Trading is a skill. Skills take time. Time requires patience. Section 9. The emotional side of trading. Understanding Forex is easy. Mastering your emotions is not. You must learn. Discipline, patience. Delayed gratification. Emotional neutrality. Risk, acceptance, consistency. Most traders fail, not because the market is difficult, but because their emotions are undisciplined. Section 10. How all these concepts connect. Let's tie everything together. Market structure shows direction. Lot size controls risk, spreads are the cost. Stop loss protects your capital. Understanding why price moves keeps you grounded. Emotion management keeps you consistent. Forex is not one concept. It is the relationship between many simple concepts. When you combine them, you gain clarity. When you ignore them, you gain losses. Conclusion. One practical takeaway. If you remember only one thing from this entire video, remember this. Your job is not to predict the market. Your job is to manage risk while taking logical trades. Focus on risk first. Focus on discipline second. Focus on profits last. Because profits come naturally to the trader who survives long enough to become consistent. If this video gave you clarity, take a moment to like the video, subscribe, and share it with one beginner who needs this level of honesty. This is the Trading Jagaban, bringing you wisdom without noise. See you in the next lesson. Trade safe, trade slow, trade disciplined.